How would you like to own investments that can actually deposit money straight into your checking account? Well, with dividend investing, you can. Today, I'm going to teach you what dividend investing is, how it works, and whether it's the right strategy for your personal portfolio. First off, let's start with some definitions. Dividends are cash or stock that a company pays to its shareholders out of its profits. And dividend investing is an investing strategy where you seek high dividend payments from your investments. Or, in other words, dividend investing is just picking the investments that are going to regularly pay you more. Growth stocks, or stocks that are expected to grow faster than average, such as Amazon or Meta, are not a good fit for a dividend investor seeking regular payments because those companies don't usually pay out any dividends, let alone high dividends. So instead of directly receiving dividend payments from the company, that income seeking investor would have to regularly sell off their stock, potentially at a loss if the stock is down, and that would constantly decrease their ownership of the company. Dividend aristocrats, on the other hand, are companies that have regularly provided and raised their dividends for decades, so their shareholders can more so rely on regular, sustainable dividends without needing to worry about losing equity in the business. You can think of dividends like subscription services, but in reverse. Rather than paying Disney every month to access Disney Plus and Hulu, you could instead buy Disney stock, own part of the company, and then receive money from the company's profits. Dividends are also an extremely important consideration for long-term investors because without dividends, the long-term investor is then forced to rely on others to eventually buy out their equity in the business. Imagine a business that somehow makes trillions of dollars, but it promises that it will never pay out dividends, it'll only ever reinvest the profits. If none of that business's profits will ever be passed on to the shareholders ever, then the business is effectively worthless to the investors no matter how much money the business makes, because they will only ever receive 0.00% of the profit. Someone else, yes, might be willing to pay more than they did for their equity, but logically, nobody should be willing to pay anything for the equity at all, because without the company paying dividends ever, the equity has effectively zero returns. Each and every single company has to make tough decisions when it comes to either reinvesting their profits or dispersing them among their shareholders as dividends. And the dividend investing strategy is simply betting on today's well-positioned companies that already have a strong history of paying out dividends. But there is a Goldilocks zone of dividend rates that you need to be aware of, and here's what that kind of looks like. If a company has no dividend or a low dividend, then it is generally considered higher risk because the shareholders aren't currently being paid out much in terms of profits. 2 to 5% is generally considered the sweet spot for dividend investing because it provides a good balance of both dividend yield and growth potential, while rates above 5% are again generally considered high risk because the company is paying out a lot of money to shareholders. A company that has consistently paid 3% dividends and that has a decent growth potential is much better than another company paying 8% dividends with a very poor outlook and a likely dividend cut coming. So make sure to do plenty of research, especially if you're picking individual dividend stocks. The pros of dividend investing are regular income, reinvesting your dividends gains your equity, and you generally have lower volatility than you would with growth stocks. But the downsides include less reinvestment by the business means it's going to have slower growth internally. Dividends can always be cut, and dividends can be taxed as income, even if reinvested, if you're not doing that inside of a tax advantaged account. However, all of these downsides can mostly be mitigated if you, number one, reinvest all of your dividends, number two, invest in companies that have strong dividend histories, and number three, if you do all of that inside of a tax advantaged account like a Roth IRA. When it comes to specific dividend investing strategies, here's a couple that you might want to consider. There's dividend growth investing with companies like the dividend aristocrats or the dividend kings that have consistently raised their dividends over time. There's high yield dividend investing to have higher cash flow with companies that tend to pay higher than average dividends. And then there's dividend ETF investing for very high diversification, lower overall risk, and more consistent dividend rates. And as for alternatives to dividend investing that you might want to consider, I recommend growth stocks if you want less income and more return potential, or there's total return investing, which is a balance between growth and dividend stocks. There's real estate, whether with REITs or with becoming a landlord to get higher cash flow, or does bonds for more stable cash flow but for lower overall growth potential? Dividend investing is best for the long-term investors who want a balance between both income and growth. It's relatively conservative, a medium risk approach to investing that's not likely to make you either super rich or super poor very fast, because instead, dividend investors usually enjoy slow, stable growth with dependable companies, and their accounts experience strong compounding over time as long as they reinvest their dividends. If you want to start dividend investing, you'll first want to consider those strategies I mentioned and come up with a plan. Do you want to do research and buy individual stocks, or would you rather just buy a dividend ETF and leave it for as long as you need to? What dividend rate are you shooting for, and why that rate? Beyond such considerations, most beginners would do very well to just stick to dividend ETFs like SCHD, aka the Schwab US Dividend Equity ETF. And then if you want to then expand to individual stocks, I would go to the Dividend Aristocrats, the Dividend Kings, or REITs would all be a great place to start researching. And since dividends are paid out by everyday companies, you simply invest in the stocks of those companies in your stock brokerage of choice. And if you don't have one, I've listed a bunch of my favorites in the description. To recap, dividends are cash or stock that a company pays to its shareholders from its profits, and dividend investing is an investing strategy where you seek out higher than average dividend payments from your investments. If you found this lesson insightful, I'd really appreciate it if you go and invest in that like button, consider subscribing to the channel, and check out these videos for more.